Hi, welcome everybody to this session. Hopefully we're going to have a very interesting session for the next 35 minutes or so. I'm delighted to have a great geographical representation across our advisory. We have reps from Paris, Frankfurt, Milan, London. We are geographically diverse, I'm pleased to say. So hopefully we'll get some great views going forward. Now this panel, this advisory group has been thinking about the subjects that have been aired and are being aired at this conference for the last 6 months or so. Many calls, many emails have been back and forward between the lot of us on this call and on this panel now. But what I'm trying to do today is to try and draw out those major themes that we've been debating and talking about and get the commentary of the advisory board of this conference to opine on it. One that clearly kind of stood out for this conference in a 10-year perspective, by the way, that's the other thing we're trying to do on this panel is take a very long-term perspective of these issues. The evolution of electronic trading clearly is close to the hearts of many people in a general sense. That's a trend that's been going on for quite a long time. So Juan Landathabal from GAM, if I can come to you first and ask for your views, how do you view that long-term trend that has been going on for as many years as I can remember? But what's the latest for you in the perspective of what it was like for the previous crisis, financial crisis, and then this sort of crisis we had this year?
Hi, David, and fellow panelists. Yes, I think you picked the standout difference for this for the markets looking at the decade view. It is the evolution of e-trading, without a doubt. It's essentially evolved from being a liquid govies and liquid IG only electronic market to encompass almost all, I would say, fixed income instruments, including derivatives, high yield, EM, even munis we've seen over the past couple of years, and most recently portfolio trading. So there's definitely been an increase in the scope of instruments traded there. And I'd like to also point out that not only have we seen that progressive, as you mentioned, evolutions of instruments and volume traded on or electronically, but we've also seen a proliferation of different platforms and e-solutions coming along with this across the fixed income spectrum, which has been a very, very interesting development.
Juan, I'm not going to say that you're too old here. Please don't take this the wrong way. But did you experience the financial crisis for e-trading, and did you experience March? And how would you compare and contrast the two crises from your side?
Indeed. So no offense taken there. Thanks, David. No, I would actually argue that e-trading did not fare that much better this recent COVID crisis compared to the financial crisis in 2008 on a relative basis. And I want to underline that relative basis. Yes, we continue to trade more in E and on platforms compared to the previous crisis, but if we compare it to the amount of volume and the strides the market has made during normal times, this time round, risk transfer and price discovery in any meaningful size quickly reverted back to voice across most instruments. So from an expectations perspective, almost, I would say it underperformed. Clearly, the experience was better than in 2008, but really, the market was quick, at least for a week or two in the depths of the crisis, so we say that liquidity crisis, to revert back to voice for risk transfer.
I'm going to switch to Paris now, Jan, if you can hear me. So
yes, I can.
What was the crisis like for you, and what's the trend of e-trading like seen from Paris?
But it was exactly what I've been mentioned by Juan. It's we saw a shift from the e-trading to the voice trading at the top of the crisis. It was the same than 2007, 8, and 12 as well on the Euro-Govies space on sovereign crisis. And in the recent one, we moved, clearly from the E to the voice, and also the benefit of the portfolio trading mentioned already initially by Juan as well, where this new protocol were also, a new one which help us not only during the crisis, but since we traded in 2018 at BNP Paribas. That was something which was really helpful for us to increase our operational efficiency. That said, it does not really make sense on every trade because for sure, as well as the portfolio trading are mainly based on e-algos, I would say, given by the banks. The e-algo was not necessarily on top and also were switched off from the bank, and the portfolio trading at the market, crisis, dev was really difficult to trade, to be totally clear. So the emergence of this kind of new protocol was very helpful, where it makes sense, where your investment needs is necessary for a kind of funds, which could be redemption, rebalancing, or ramp up. So that's something which is essential. And I think, to me, one was the protocol which were the most important, where the crisis was the most difficult. It was the human protocol coming back to on top, where the human relationship were essential to the trading activities. To me, that's
excellent. Yeah, thank you. Christoph Hock, coming to you next. In Frankfurt, what was the experience of e-trading? Did you find yourself reaching to refresh your phone book and your Filofax, your Rolodex numbers and calling people, or did e-trading help you in this crisis in March, Christoph?
Thanks, David. Actually, it was a mixture of channels we experienced, we made use of, and when comparing the individual asset classes, as you know, we are set up as a multi-asset trading desk. When comparing the asset classes, you see that there's not the silver bullet. So there's not an electronic solution only. There's not a voice solution only. I think it's the kind of combination which delivers best in class execution to our investors, actually. I can absolutely echo what my two colleagues were saying. So during the COVID crisis, we saw a shift back to more voice trading, especially in the less liquid asset classes. But then back in April, May, we saw kind of normalization where electronic trading and also within electronic trading, automation came back. So all in all, as I said, it's like playing a piano. You need to play the white keys and the black keys, the pedals to make a great symphony. And that's actually how we were playing the different channels.
Okay, well, I'm switching to Italy, and Michelangelo, as you know, I mean, we all sadly know Italy led the Europe into the COVID crisis in some ways in terms of timing. But what was the effect and realization? And by the way, you're on mute, Michelangelo, in case you want to come off. So basically, what was the experience based out of Milan of the general e-trading, trend that we've been experiencing for the last 10 years? You're still on mute, Michelangelo, I think.
We had the same experience my colleagues had in the other capitals. We had to reinvent ourselves some weeks before my colleagues. And in this exercise, it was necessary a lot of flexibility in terms of organization and in terms of trader deployment across different tasks. Basically, all the trades have been done voice. So at the end, as my colleagues said before me, everything went voice, and it was a very the price discovery exercise was a very tough one. It was necessary a lot of let's say patient and a lot of time in order to address all the deals, all the trades we got from our PMs, and just the team organization. Team organization was a very an important important setup in order to address all the things we had to do in March. So it was a tough time, absolutely, and it was very, let's say, stressful time. It was very a stressful situation, but at the end we we survived. So.
Okay. Just to come back to, because I believe maybe Christoph can comment on this, or you, Michelangelo, cross-asset responsibilities, equities, FX, fixed income. We're talking about obviously fixed income at this conference. Was that, if you like, rollback or slight blip of electronic trading and the move back to the phone? Would you say that was similar, Michelangelo, across the asset classes, or was it more extreme in fixed income?
That's a very important point because at the end, all the problems have been on the fixed income side, in a sense that we had a very huge volatility across all the asset class, because we had the very important repricing across fixed income, equity, and FX. But when we saw screen regarding equity prices on FX, we knew that the prices we saw on the screen were more or less true. This was not the case on the fixed income side. So that's something we have to think about, because it's clear that anytime we have a huge repricing across in the fixed income space, we have to, we know that at the end, the principal protocol maybe doesn't work as it should be, as expected, in a sense that we cannot rely on dealers, on market makers to be buyers of last resort for all the market. This system at the end doesn't work when we have this kind of situation, and this is something that will stay with us over the next months, years, I would say.
Okay, well, listen, we're going to come to Liz in a second, but I think Christoph Hock, you have a cross-asset perception to add in here. Christoph.
Yeah, sure, David, more than happy to comment. As mentioned before, I think it was really about the general liquidity of the individual asset classes. So there was not per se a message that there were difficulties in fixed income, but not so in FX, or not so in equities. So in fixed income, obviously credit by definition is the asset class where liquidity problems raised first, and in this area, especially in the high yield space, but also when looking at FX. We experienced in emerging market currencies. We experienced in roll activities. So typically the ones which are more difficult to trade. Liquidity issues, and in equities, blue chips, they were fairly easily tradable, as so liquid index futures in fixed income, in fixed income and in equities. But in the equity space, also small mid caps, they were difficult to trade due to liquidity constraints. And from our perspective, what was really a big game changer was in the very quick reaction of governments in the second half of March with their massive stimulus programs. And on the other hand, the central banks, they acted significantly faster compared to what we experienced back in 2007, 2008 during this financial crisis. And with the ECB stepping into credit markets, with the Fed stepping into credit markets, we saw a significant easing after having had a 2.5 week period of stress. And then also credit, which for sure was one of the bottlenecks in the fixed income space. Also credit was much easier to trade again, and well bid in this context.
Okay. Well, listen, we're going to go on and talk about trading protocols in a second, and then also the big subject of regulation. But before we move away from this sort of e-trading trend, I just want to bring in Liz Callahan from the ICMA. Clearly, I think most of these guys, if not all of them, are members of the ICMA, and you know, but does this gel with what you're hearing, Liz, from your members about the general trend of e-trading and how it did or did not support these members during the crisis?
Yeah. Definitely. There's sort of two things here. There's the crisis management and electronic trading, and then there's evolution of electronic trading. The only other thing that I heard, I mean, I absolutely echo everyone is saying what we are hearing in ICMA. The only other thing I would say that would have helped in this COVID crisis during trading or during lockdown, et cetera, was had we had a fully functioning consolidated tape with the data available, that would have helped. And most of the traders said that that would have helped them. Again, fully functioning, correct liquidity assessment, everyone contributing. So that would have helped. But regarding the evolution of electronic trading, sort of taking a step back, for my background is actually way back in equity electronic trading. Then I moved into bond electronic trading. What I've seen certainly, and what most have seen, is the borrowing of some of the tools from equities, equity asset class into fixed income. So algos, portfolio trading, direct trading, anything data-based trading to go into fixed income. And then the importance of an order management system, allowing the workflow to gel. I would say that is very much now in fixed income where it had been in equities only for a long time. So it has evolved. Those are my thoughts. Thanks,
Okay.
Dave.
Thank you very much. Well, listen, I want to go back to something we did touch on a bit, Jan, in Paris, if you don't mind, the protocols that are in existence nowadays versus, again, I'm trying to take the long view, 10 years back, 10 years forward, but let's just 10 years back. It was all about RFQ, just RFQ. There was little choices, etc. But go through the protocols, and if you may, maybe overlay what we've just been talking about. How useful were some of those? Portfolio trading, streaming prices, auction models, whatever you can think of. But how have those protocols, the new ones especially, help manage the last year or so?
Clearly, I think all the protocol, to come back what Liz says, were also, enabled by the data, I would say, and the growing IT, growing technology, I would say, and the electronification of the fixed income market that we saw, since 2007, an increase in terms of data quality, which is not perfect, as we know, but which is better than nothing, having some, stream prices, axes coming from different market vendors, etc. But very helpful to when once you aggregate everything, to be able to choose your, I would say, your preferred or most efficient protocol at the point you need to trade a specific bonds, whatever govies, credit, emerging on high yield, etc. So from what I can remind to my experience, my trading experience, and also, since I joined, BNP, is that, it's clear that the main one used is clearly the RFQ protocol, whatever or voice trading, and also the, we saw request for market, request for streaming, but according to me, it's not yet, fully, I would say, live and ready to go as a standard. The one which is more coming was the open trading or all-to-all, which were really efficient at some point, but deepening the market, because it's have to be also take into account that the impact of your I would say your market impact, that could be extremely important. And the portfolio trading, which is the new one coming in since the coming months or last year, I would say, for us in 2018 on the euro, where we do 20% of our orders of our execution via portfolio trading, which is huge compared to what we saw. We started a lot. The one also we increased and we switched off during the crisis was the auto trading, where we in March, for example, we switched off the auto trading due to the fact that the spread was widening on some peaks, on some peripheral bonds, and we switch on back in June. So that's protocol we need to embrace on the trading side, to be more efficient. But I would say the protocol depends your investment need and your trading approach. It will define your trading approach. It will depend of the market liquidity, and as well of the data you will be able to aggregate at your market level, at the trading level, I would say.
Okay, well, listen, we're going to see what the view from Frankfurt on that is, and then we'll go to Milan next, if you like. I like this geographical diversity. It's brilliant. So in Frankfurt, Chris, it sounded a bit like you've got to make sure the data's right going into these trading protocols. It's all very well having electronic trading and trading protocols, but it's data driven. But what's your experience of these protocols and the sort of different ones available to you now in fixed income?
I think it's great to see the flexibility also in the fixed income space. You rightly mentioned that about 10 years ago, the market was dominated purely by RFQ. But due to various regulatory initiatives, broker firms, established broker firms, investment banks, they do not offer the kind of liquidity anymore as we experienced years ago. Balance sheet is more expensive. Prop trading is not allowed anymore. The keyword here is the Dodd-Frank rule. And that's why, from a buy-side perspective, you have to assure that you tap new sources of liquidity, so to say. And on the one hand, yes, the bulk of the business is still RFQ driven, but as Jan was mentioning, there are other formats, other protocols right now. So during the COVID crisis, what we experienced that trading against peers, so being active on all-to-all platforms, was extremely helpful when sourcing liquidity. On the one hand, you experienced that you've had forced sellers on these platforms, having had to trim down their portfolios. On the other hand, you've had counterparties sitting on cash ready to invest, taking the opportunities. And so it's not necessarily anymore the case that on the one hand you have a buy-side firm, and on the other hand you have a sell-side firm, and an RFQ brings these firms together. So therefore, we really like the various platforms. Innovation increases obviously also competition, and gives us, on the other hand, a really good opportunity to find the very best source of liquidity, and as said before, to live the best execution in a very best way.
Okay. Well, go down now to Milan. Michelangelo, if you can come off mute and comment from your point of view. Is the protocols? Is there any new exciting protocols for you in fixed income that you've come across and you like?
Well, I tend to agree with my colleagues in a sense that none of these new protocols we got over the last years or months is the silver bullet for the fixed income business, in a sense that nowadays request for quotes still prevail across compared to the other protocols. They are very good innovation. They are very good tools that you can use in times of peace. But in terms of war, such the ones we had in March, I'm not sure this protocol could have been a solution for our problems. So there is a general problem in the fixed income space that needs to be solved. I hope in the next 10 years something will something very new will born. We need a solution, because this asset class actually, anytime we have a huge repricing, suffer, let's say, minor or big problem. It depends of the magnitude of the repricing. But
okay. All right, I'm going to switch back to London. Maybe there's this thing that we could use, the old mobile phone as well. That probably came into it as well, I believe. But Juan, back in London, what's your view of the protocols? Was there something exciting developed that in the last 10 years or recently in protocol terms for you?
No, I would agree with my colleagues. I think that all-to-all, more market participants, and that includes alternative liquidity providers, as well as buy side being more active in the price decision making when it comes to trading. So I think we're going to continue to see an evolution of that. Again, a lot of that is a bit hampered by just the way structurally desks are set up and portfolio managers, etc. There has to be increase, should we say, an increase in the ability of buy-side traders to work orders confidently in the market in order for this to bring even more liquidity. But if I may, David, I'm going to change gears slightly and say what has not changed in e-trading over the past 10 years since the last crisis, and that is the new issue market. On the one hand, we're talking about all these wonderful algos and portfolio pricing and technology that's been able to bring alternative liquidity providers to the table, and yet here we are stuck in the same way that we were doing new issues, I would say even prior to the turn of the century in 1999. So yeah, that is a call to the industry as well.
Right, I think they've got rid of the carrier pigeon has stopped being used, though. I think they have stopped using the pigeon, so it's fine. But no, you're absolutely right. Please do mention the big things that haven't changed. That's a good way to think about it. I believe there is talk about primary markets in another session, but that is certainly something that we identified as being very relevant. Absolutely. But I'm conscious that there is a big one in the room that we haven't got to yet. And Liz Callahan, I'm going to come to you on this one because you did sort of allude to it. And that is the issue of regulation and what's been happening over. If you took a 10-year view on regulation, I guess things are very different now. And you mentioned the consolidated tape, but what is the regulatory driver for you? And I'm going to ask Christoph to comment after that.
Yes, well, of course, MiFID is the elephant in the room. There was MiFID 1, which was equities only. And then there's now MiFID 2, and I don't know if you've all been seeing what is arriving today, but there are all sorts of MiFID opinions and proposed amendments coming through from ESMA. So we'll be tackling that in the next couple of days. But the thing that it has been very frustrating from a fixed income point of view with MiFID is a couple of things. The whole concept of equities and non-equities. As far as I'm aware, non-equities is not an asset class. That would be the same thing as if we in bonds called all other asset classes and grouped them together and called them non-bonds. So that has caused a lot of confusion, not helped by the fact that MiFID 2 was very much of an overlay of equity language and thrown into fixed income. And that caused problems. It was also overly complicated and trying to do too much of a huge big bang all at once instead of a staged delivery. So with that, we have, it hasn't really delivered on some of the prime elements that it was supposed to. I'm not saying that MiFID hasn't benefited people, I think, and the industry. I think it has, because a lot of people were forced to look under their hoods and see what their trading and their workflow was like and how it could be improved. So I think that's very, very good. And it's made you think about safety. But, pre-trade transparency, nobody is using MiFIR pre-trade transparency. They're all using axes, which are indications of interest in the fixed income market. And, the importance is really post-trade transparency, but they have to get that right with the deferral regime and the very different deferral regimes that are throughout Europe. So, there's some big problems with it, but we're inching along the way, but there's still a fair amount to go.
Liz, thank you. I'm just conscious I want to get the other guys' views on this major area, regulation. So Christoph, we've got about 5 minutes to run. So can you do two things in one go, which is talk about regulation and is there anything else that we've missed, big themes that you'd like to mention? So regulation first, Christoph.
Yeah, sure, more than happy, David, thank you. So the last 10 years plus definitely were a decade of regulation, and it started after the financial crisis in Pittsburgh, when the G20 ministers came together discussing about how to make markets more stable. And actually the first asset class where we saw regulation as a big game changer was equities with MiFID I back in 2007, 2008. We saw higher level of transparency. We saw the fragmentation. Then as a second asset class, we've had derivatives affected with all the EMIR ruling, also with implications on interest rate swaps and CDSs in the fixed income area. And then, as Liz was mentioning, we've had MiFID II back in 2018. And this was really the first big regulation affecting cash fixed income markets. What else was it we need to have on the radar screen? I mentioned Dodd-Frank a couple of minutes ago. Dodd-Frank prohibiting prop trading. Prop trading we saw in the over the last 10 years where it was still allowed as a kind of natural buffer. When markets were suffering, you've had typically prop books with contrarian positions and acting in this instance as a kind of a smoother on the way down. And no prop trading definitely had big implications also to fixed income markets. And we've had Basel III with making balance sheet much more expensive. So investment banks, broker firms running positions overnight, they have to put more capital into play than it was 10 years ago. So big impact from regulation, big impact on liquidity. So not only from a buy side and sell side perspective to the better. Markets are more stable, yes, but it had implications to cost of trading. It had implications to liquidity in various sub-asset classes in fixed income.
Christoph, great. Thanks very much. Just to get final remarks from anybody. Jan in Paris, have we missed anything big that we haven't talked about today?
I think, yeah, something which would have been interesting to talk about is data. Data are essential, to me in the coming years. We saw that data at trading level were extremely important to understand where market liquidity was moving, and also the trend in profiling all the I would say all the protocol. So that's one of the missing points where we should need an increase with collaboration in banks and also market vendors as well.
Okay. Juan, back to London. What final remarks, comments from you?
Yeah, I've unmuted myself. Good, yeah. For the future then, over the next 10 years, I think it's more data, better data, an increased capacity to process the data to aid with the decision making. I think for the buy side, the capacity to ingest ACS and pricing data, pair it up with trading history, and then use it to determine where and when to trade, in what size or even what type of protocol, in order to maximize our liquidity and, just as importantly, minimize impact. And for the sell side to leverage capital, leverage capital by increasing the velocity of their trading books, and off the back of better pricing, better hedging, due to database modeling and programming. We've made some strides in this regards, but I think there's much more to come on that front.
Okay, and Michelangelo, final thoughts from you from Milan. What are your thoughts? You're on. I think you're on mute. Sorry, Michelangelo.
Well, I tend to agree with my colleagues. They are perfectly right. Data is very important, is something regulators should have a look at. And what we learn from this crisis that we cannot run properly this asset class without dealers. So I think regulators should have a look about the cost of capital in order to run inventories in dealers' balance sheet. So maybe it's time to have a deep look, because we learned that we cannot handle this crisis without dealers' balance sheet. So that's a fact.
Okay, Christoph, in 15 seconds or less, because we're running out of time. We need time for questions. You have a comment, I believe.
Yeah, for the last 10 years, we've been a service function for our investors, actually delivering best-in-class service. And that's also our role for the next 10 years. And figuring out where's in the fair value of a bond, i.e. we need data, figuring out where the best sources of liquidity we can find, broker evaluation. Again, we need data. That's key from my perspective going forward.
Okay, and Liz, I don't want to be ungentlemanly and not give you 15 seconds. It's final thoughts, please. But
okay, I have 4 words. Industry and regulator interactive relationship. We can't get any of this unless the regulators actually work with the industry more on an interactive basis and actionable basis. Thanks.
Okay, thank you. A plea for collaboration and coordination, I think there, Liz. Thank you very much. And it just remains for me to thank everybody for the panel and all the advice that you've given this conference and input you have. I think it goes unrewarded from everybody in the conference. So thank you very much for all this input. It gets us talking about the right things. Thanks, guys.
Thank you.